Good morning and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Thursday, January 30th, 2020, almost a month in the books of the new year. And January, I actually do a January effect analysis every year. And the month of January actually is a very, very good predictive indicator of how the market will do the balance of the year. If you have one of the strongest Januaries, and I look back over the last 70 years, if you have a really strong January, one that fits in that top 25%, that top quartile, that normally results in a very strong balance of the year. So where we finish by tomorrow afternoon could help us, at least give us one more signal as to what we might expect over the balance of the year. Got a lot of stuff going on today, so why don't we just jump right into the agenda, and I'll go through what we want to talk about today. We've got the daily market recap, of course, so we'll take a look at what happened yesterday. Talking technically, just want to go over the S&P 500 quickly and give you a little bit of analysis from an hourly and daily perspective, some things maybe to look for. Earnings spotlight. A lot of earnings coming out. Apple reported, and of course, had a nice rebound or nice bounce with their earnings report yesterday. And then last night, Microsoft, Facebook reported. We're going to take a look at a lot of reports there. Upgrades, downgrades, just a couple I'll share with you, and then get into predictive strategies. And this doesn't have to do with the January effect, which is a different kind of predictive strategy. But I use relative strength a lot in analysis and determining whether or not I would hold a stock into earnings. I'm short-term trader. I really don't like to hold stocks into earnings, but I do think that there are some hints in the market letting you know whether or not it might be worthwhile to hold on or not. And so I'm going to go over some of that. I'm going to spend a lot of time try to go over a number of reports and just give you a little idea of what I do there. I actually had a webinar last week, and I've got another one coming up on Saturday, and I'll give you some good information there. And then 3 you must see. I always like to wrap up the show with 3 charts that look interesting to me, and they might look interesting to you as well. All right, I do have an event coming up on Saturday, as I mentioned, and the key part of it is just to explore this new StockCharts feature, which it's a new chartless sharing feature where I could literally send you a link, and you could click on that link and download the entire chart list up to 500 stocks into your account immediately. In the past, what I've had to do, because we do this with our members at Earnings Beats, in the past I've had to send out one by one a chart list. So for instance, the strong earnings chart list that we have, every member, I would have to go out and send it to them individually, and then they would download it individually in their account. Now I can simply provide the entire membership or the entire StockCharts audience a link, and if you're a StockCharts member, you can, an extra member or above, you can click on that link and download the entire chart list, annotations, chart styles, everything right into your account. It's a really cool feature. And so I don't think a lot of folks realize how cool this is, but I'm going to talk about it on Saturday. And within that, I'm also going to be talking about earnings, upcoming earnings in the next week that I wanted to share with some folks as well. And you'll see how important that is in just a few minutes when I get to predictive strategies. But let's go ahead and just show you what you need to do. If you want to attend this webinar on Saturday, it's free. And by the way, if you can't make it, there will be a recording that'll go out, so you don't have to physically be there. But let me show you what you can do. So go to earningsbeats.com. First of all, just subscribe to our free Earnings Beats Digest newsletter. Comes out Mondays, Wednesdays, Fridays. It really focuses on earnings and relative strength. So if you're somebody who is a technician, you really want to learn more about relative strength and how it can help you in your trading. And of course, everything I do really revolves around earnings. I love this time of the year when we're going in. We're starting to really get a ton of earnings reports in. But if you sign up for this newsletter, we'll be sending instructions out for the Saturday webinar to everybody that's on this list. Also, I'm gonna have some articles coming out the next couple of days, chart watchers, trading places. Be on the lookout there. I'll have links and so forth that you can follow, but it's going to be a great event on Saturday, so I hope you can make it. All right, let's move on to the daily market recap and take a look at what happened yesterday. So we had some big news yesterday. We started off the day, we had gotten Apple's news, which they absolutely just blew away the numbers, and I knew they would. And again, it comes down to how a stock performs heading into earnings. When you've got a stock like Apple that's been going straight up, 50% move in 3 or 4 months, that's what we've seen in Apple. That's telling you that Wall Street's expecting a big number, and we should too, and that's exactly what they delivered. So Apple had a huge day, big gap up, and then at 2 o'clock, the Fed came out and said essentially the same thing that it said the last meeting, that they're going to keep interest rates low, that they really want the inflation rate to move back toward the target rate of 2%. I think that means they're going to have to lower rates, personally. They didn't lower yesterday, kept everything steady. But also, I'll give you the GDP number in just a minute, but that inflation component also is extremely low. I think the Fed needs to lower. The Dow Jones Industrial yesterday did go up 11 points, finished up 11, but you can see it actually filled this gap from earlier in the week and then came back down below the 20-day moving average. S&P 500 essentially did the same thing. When you look across all of the major indices, we went up, we filled that gap from the big gap down earlier in the week. And then once we did that, the Fed was out, Apple's report was out. It was almost like, well, okay, let's go ahead and start selling. And so we saw that. So right now we're still in this state of flux on the overall market. And I'll pull up a S&P chart in just a minute. As far as sectors go, industrials, materials, technology led the action yesterday, all higher. Energy just continues to move lower and lower and lower. It's been a horrible drop here in January for energy. We were up to 61, almost $62 a share on the XLE, now back down under 55. So XLE is down more than 10% this month. Hard to believe. Real estate really struggling to get back through that 40 level. It's gone above there a couple of times, but yesterday did reverse, was down about 0.5%. All right, let's move into the 10-year Treasury yield, which I have a long-term chart here, and you can see the yield over the long term has been moving down. We had a stretch in the end of 2018 throughout 2019. We came down, started to move up, and that really coincided with a big move up in the S&P 500. But now we're starting to roll back over. We've rolled back over, and as a result, you can see the S&P 500 struggling now to continue to push higher. One thing that's different, I like to keep stressing this, one thing that's different now is that when we have these big pullbacks in Treasury yields, which means money's rotating into Treasuries, it's not coming out of the stock market. Here's the big drop. The S&P goes higher. Even through all of this, 2014 through 2016, we consolidated. We didn't really have a big drop. When you go back and you look in the bear market, 2007, 2009, when the yield was dropping up here, the S&P 500 was getting crushed because money was rotating out of equities. That's what was fueling the advance in Treasuries. Now it's just simply new money coming into the market in both areas. I think folks are coming into our Treasuries because our yields are higher than everywhere around the world, and we're seen as safe, as a safety net. So you've got money rotating into Treasuries, keeping the rates low. Also, inflation is low, and then you've also got growth in the U.S., moderate growth. So you're seeing a lot of these growth companies like Apple rapidly expanding their earnings. And when you rapidly expand your earnings and you change your earnings forecast going forward, you raise them, you're discounting those future revenues back at historically low interest rates. That's why we're seeing the move that we are on, we're in stocks. All right, let's move on to talking technically. I want to take a look at the S&P on a shorter time frame here. First, let's look at the daily chart, and you can see we've been moving up pretty much unabated for the last 3 or 4 months. But now we're going through a little bit of sideways action, and I think it still remains to be seen whether or not this is an A, B, C correction. Maybe we go back down to the 50-day moving average, 3,200. That would be another couple percent from here. So from a daily perspective, ABC corrections are not that big a deal. Actually, you can see one here back in May, A, B, C. And then we started rallying again. So a quick little ABC correction or corrective type move would not be bad, especially after this huge move we've made. So that's the daily. The 50-day moving average, I think to get back through gap resistance to the upside, 3,300 would be big. I think that would probably indicate we're not going back down, but we did fail near that level yesterday, came back down. So I would be looking at the lows from earlier this week. If they fail to hold, next up would be that 50-day moving average. On the hourly chart, I've still got this channel continuing to be in play. Now, if we go back down ABC and we get down to that 3,200 level, then this trend line, the channel line, will be violated. That doesn't mean anything horrible. It just means that this 3 to 4 month uptrend is probably moving into more of a consolidation phase. All right, let's move on to earnings. There were a number of companies out with earnings. I'm going to start with Microsoft. Microsoft came in, beat top line, beat bottom line. Stock was trading higher in pre-market. I think it was up a few percent. And when you look at it, look at the relative strength. Here's software going up. Here's Microsoft versus software. So you have one of the strongest areas of the market, which is breaking out versus the S&P. And Microsoft is one of the strongest stocks within the group. So that doesn't surprise me when we get a big report, we get a gap up with earnings. Facebook. Now, Facebook, on the other hand, and this is a company I'm looking for to have a good 2020. They're not going to have a good day today. Stock did break out yesterday on an absolute basis, but one of the problems with Facebook has been it's just not been a leader in the internet space. We haven't been able to get that breakout. So internets have been great, and you can see the relative strength on internets have been very strong. Facebook hasn't been one of the best of that group, if I'm being honest here. So Facebook still got some work to do. I think it's okay. Probably going to pull back somewhere around the 50-day moving average. I wouldn't be surprised to see a hollow candle print where you gap down and then rally back. One of the things Facebook did, they beat on their top and bottom line, by the way, narrowly. But they did talk about their growth slowing going forward. That's not something that the market likes to hear. PayPal beat top and bottom lines. That was good. But they did guide Q1 earnings per share lower and fiscal year 20 earnings per share lower as well. So not very good action there for PayPal. And I was going to try and get you a quick update on where they're trading pre-market. Hang in there 1 second. Good time for a water break. Okay. PayPal is down 3% pre-market, down around 113. So it's going to open below the 20-day. Does it come back up and hold it on the close? That would be good. If not, look for more movement down. I would expect maybe a 50-day test. PayPal, relative to its group, has been moving higher over the last couple of months, but it's not at a 52-week high. But things have been improving. Volume trends actually have improved as well. So I'd really like to see a rebound in PayPal today after it gaps down. Tesla, oh my gosh, can't not talk about this one. Big beat on revenues, big beat on the bottom line. Just looks absolutely awesome. The chart, look at the relative. First of all, look at the volume coming in. I mean, if that doesn't reek of Wall Street accumulation, I don't know what does. Tesla in the auto group, sending the autos higher, Tesla's higher on a relative basis. I mean, this is what you want to see going into earnings. Tesla up $60 after hours last night. So stock looking to perform really well. Another gap up. Let's see whether we put in a black candle, which could be a short-term top. But if we get any kind of a pullback to the rising 20-day moving average, Tesla looks good. Lam Research. Let's go through a couple of these semiconductor stocks. I mean, Lam Research came through. They hit it out of the ballpark. Top line beat, bottom line beat, guided Q3 revenues and earnings per share higher. Stock was trading up after hours, and you can see it's been moving up. Look at the relative strength. You know, it's in one of the strongest areas, semiconductors, which have broken out relative to the S&P, and Lam Research is among the leaders. So there's one. How about Qorvo? Another one in the semiconductors. Look at how this one's been performing. Now, when this one hit its high back here in mid-December, it's been consolidating. But when it hit its high, it was leading semiconductors, and it was leading in a big, big way. So this is a company that was being heavily accumulated, was a huge leader, and went through a period of consolidation. Well, probably not going to consolidate any longer. Big beat on the top line. Bottom line, $1.86 versus $1.67. Guided Q4 revenues and earnings per share higher. And the stock last time I looked was up about 8% pre-market. Cirrus Logic, CRUS, another stock in the semiconductor space. Listen to these numbers. Revenues, 375 million versus 345. Huge beat, about 9% beat on revenues. Bottom line, $1.41 versus $1.12. I mean, if you want to know why these stocks are moving up so fast, you know, I keep reading article after article about, oh, this can't continue. The PEs are too high, blah, blah, blah. This environment, we haven't seen this kind of an environment. It's been a long time, probably since the 1960s, where we've had historically low interest rates and moderate growth with the Fed on hold. If anything, they might even lower rates to deal with lower than expected inflation. That is nirvana for a high growth company that continues to raise its earnings estimates. That's why these stocks are going up, and that's why these stocks are not going to stop going up. The ones that are outpacing their growth to continue to raise estimates and beat estimates, these are the companies that are going to perform extremely well in 2020. All right, a couple of earnings that came out this morning I wanted to just talk about real quick. Coke, KO, they beat on the top and bottom line, 44 cents versus 43. And the stock has been trading really well. Look at this, 52-week relative high to soft drinks. So we shouldn't be surprised when a company like this comes out with a strong earnings report. How about Eli Lilly? Beat on the top line, beat on the bottom line. They guided their fiscal year 20 revenues slightly higher. The stock was only up, I don't know, 1.5% pre-market. But look at the relative strength, Lilly versus the pharmas. Remember I was talking about, I think it was on here on Tuesday, talking about Pfizer and how I didn't expect much out of Pfizer. Look at the relative strength on Pfizer. Look what it did after earnings came out. Completely different landscape. I mean, Wall Street is telegraphing to us which stocks we should be thinking about, which ones we shouldn't. It's almost like we're in the analyst meetings with them. But anyway, let's maybe take a look at one. Oh, DD. This is one I gave to Earnings Beats members beginning of the week, one I didn't like. Heading into earnings, you can see DuPont, Denimores here moving lower on an absolute basis and also on a relative basis. Not only is it one of the worst stocks in its industry group, but its industry group is one of the worst industries relative to the S&P. So you really don't want to be looking at a stock like this and thinking, oh, let me go ahead and jump in, because when you miss earnings, the valuations just keep dropping. So DD today, I wanted to just give you a quick update on the numbers. I'm not getting it up just yet. But, you know, when you see a stock that's downtrending like this and volume's been pretty strong and it's just not going anywhere, you don't want to be part of this. DD is down 3.33% pre-market. So another $1.94, 55.75, setting a new low. Eventually, some of these stocks will be leaders and they'll be relative leaders, and that's when we want to own them. Right now, no thank you. All right, let's see. Let's move on quickly to upgrades and downgrades. And in upgrades and downgrades, the first one, I just want to talk about Apple for a second. Apple, of course, beat yesterday, had the huge move up, gap to a new high. There is a negative divergence. Stock was upgraded. You know, it broke out yesterday with a negative divergence. If it can't hold the breakout, if it closes back below 320, then we might see a period of consolidation in Apple. I don't think the run is over. I think Apple goes higher. This is one of those high growth companies in a low interest rate environment. And if they continue to perform well and Wall Street keeps getting good signals from them, you're going to see this chart just keep going higher. But now that earnings are out, this would be the time maybe we get a little bit of a pause. So I agree with the upgrade on Apple. I just don't know if it'll continue to move higher in the short term, especially if we get a close back down below that 319, 320 level. Stitch Fix also upgraded today. I don't know why. When I look at this, I'm pulling up on a relative chart. You know, we've got clothing and accessories breaking to new highs, but Stitch Fix did not. And as a result, look at the relative strength. We're down near 52-week low. No chance I would upgrade this stock right now. Downgrade today, ANET. This is Arista Networks. I would agree with the downgrade. We had the huge gap. We've moved up very close to gap resistance. The group itself is horrible. Yes, ANET has rebounded in relative strength, but a lot of that is because the stock dropped $70 in one day. So it's kind of like this 2-month-long or 3-month-long dead cat bounce to try and fill this gap. I'm not convinced at this point. I would be very careful with ANET. I agree with the downgrade. Expedia, the last downgrade, I would agree with this one as well. A lot of these travel-related stocks right now with coronavirus really struggling, and the stock got very close to the bottom of gap resistance near 115, failed, started to roll over, and you can see on a relative basis not doing very well relative to travel and tourism. So I would definitely take a pass there. All right, let's move on. And I want to move on to predictive strategies. And so what I'm going to do with this, and I hope this works, I am going to share my screen with you. It's going to be a kind of like an Excel spreadsheet kind of a form. What this is basically all the stocks I gave to Earnings Beats members at the beginning of the week. And from DHI down to CHTR, these were all stocks that I liked going into their earnings reports this week. I liked the way they were setting up on a relative basis. I thought that they would come out with strong earnings. I thought that they had a chance to do well in terms of price action. And at the bottom, I gave 8 stocks I did not like. Now, what I've done going across here, just to explain this quickly, and I'll talk more about this and also give picks for next week at the Saturday webinar that I mentioned. If you came in late, go to earningsbeats.com and make sure you sign up for our free Earnings Beats Digest newsletter. You'll be sure to get room instructions on Saturday. If you can't make it, again, no big deal. We'll have a recording. It is a free event. But here, look at DHI. So this is DR Horton. The close before they came out with earnings was at 58.51. So the next column here, I have an open the next day after earnings. So it opened up little over 1%. It closed the next day at 59. So it's up 2% at the first day after earnings. And then 3 days after the earnings came out, I didn't do the percentage yet, but you can see these stocks are up pretty nicely. Here were the numbers that came in. And again, I was expecting numbers that beat Wall Street estimates. And when you look down this list, the green beat, the red did not. Now, of all the stocks I gave this week that have reported so far that I expected would go higher, only one, ARNC, came up short on earnings, 53 cents versus 54. And they actually raised guidance, which is why the stock went up from 29 to 31 3 days later. So even though they missed, I don't know, maybe Wall Street knew things were going to be improving, whatever. The stock was performing well on a relative basis and then came out. But this was the only one that missed, and that's a lot of companies to predict. We had ROK, which matched expectations, eGov matched expectations, and LLNW matched expectations. Those are the only ones that matched. One missed, and all the others beat, many of these beating by a mile, like Apple, $4.99 versus $4.54. What else do we have on here? How about Microsoft, $1.51 versus $1.32? I mean, these numbers aren't even close. If you've got Microsoft, if the valuations are based on Microsoft, their prior numbers, well, guess what you have to do now that they're coming in with new numbers like this and raising guidance? You've got to change your forecast, which changes the valuation. Those future earnings are worth a lot in a market where your alternative is to buy a 10-year Treasury yield for 1.6%. Earnings mean a lot in this kind of an environment. And I think that's what a lot of people do not get about this rally in the market and why it is going higher. Unless something changes where we get inflation all of a sudden that, starts to make the Fed raise rates multiple times, many times. It would take a series of rate increases. Unless we see something like that, or the coronavirus, which is spreading, but at this point impacting maybe travel stocks, unless it gets to the point where it's really become more of a global concern and spreading rapidly, yeah, that's something that the market it's unexpected, could certainly hurt the market for a period of time. But these are things that we should be thinking about. Down at the bottom of this list, you can see the stocks that I said, I think they are just not performing well. Going into their earnings reports, don't expect much. Pfizer was mentioned. 3M, I wrote about it last Saturday in ChartWatch or in Trading Places. or maybe was it? No, it was Trading Places. I said buy Apple into earnings. Do not hold 3M into earnings. And you can see the stock getting hit, missed revenues, missed earnings. Relative strength matters. And so hopefully you can join me. This morning, DuPont was one on the list that I had given. And you can see DuPont, I don't have it up here, but they missed top and bottom line. So you can see the frequency of the misses on stocks that are not performing well on a relative basis swamp the misses that you see on companies that are reporting strong. All right, so let's move back over. And I want to go into the 3 you must see. So let me pull up first. Let's see. First stock today will be MSTR, MicroStrategy. All right, so what do I think about MicroStrategy? Well, MicroStrategy on a relative basis has been trending lower. Yesterday, tried to make a breakout. I actually sent this out to members at Earnings Beats, sent like 6 or 7 different breakouts, intraday MicroStrategies. And I said, we got to watch, don't want to leave that long tail to the upside. I think it was around 161 or 162 when I sent it out midday. Look what it did. It came back down, closed at 152. So it fails on the breakout with horrible relative strength, one of the worst software stocks. So if it can't make the absolute breakout, I already know relative strength isn't good. I don't want to touch the stock until it makes that breakout. So I think that big reversal is certainly worth noting. Next up, Rambus. Now, Rambus is an interesting stock because if we go back to a long-term chart, I'm going to go back about 8 years here. You can see we had a big drop. We come back up and we really struggled. We have not had a weekly close above 16. Right now we're trading at 1604 with 2 more days to go. It looks like, and look at the volume coming in. I don't know how we finish again. If at the end of this week we're back down at 14.5, I'm not going to be very impressed. But if we can continue this push, this is a big breakout opportunity here for Rambus. So we go back to that 1-year chart and just realize that this move yesterday on heavy volume was taking out a 7-year reaction high resistance level. We have not been able to clear $16, really 15.5 to 15.75. And here we are doing it yesterday with increasing volume. So Rambus, I think, is an important one to watch. And then finally, TNDM, Tandem. This was a big breakout yesterday. I've been waiting. This stock has been very frustrating, back and forth in a wide trading range, $50 to $75. Up, back down, up, down, up, down, up, down, just going back and forth, dizzying. Yesterday, look at the volume coming. It broke out above $75. That is a big breakout. Now, if the market is weak, I know futures are red this morning. If we get a pullback, I would be watching this rising 20-day moving average. You can see it bounced beautifully earlier this week off of it. If we get a head fake on this breakout and pull back, I think that rising 20-day is something to watch for sure. So one last thing, if you came in late, just want to mention, do have a big event coming up on Saturday. I'm going to explore the new StockCharts.com feature, which allows me to send chart lists and for you all to be able to receive them and just click a link and download them right into your account. Replace an old chart list, add a new one, whatever. It saves all the annotations. It saves the chart styles. It's really a cool feature. And I want to talk about that on Saturday. If you haven't already signed up at StockCharts for a free 30-day trial, you'll want to do that because you're going to want to try what I'm going to be able to send to you. You want to make sure you're able to download it. But anyway, that'll be on Saturday. Go to earningsbeats.com, sign up for Earnings Beats Digest, and we'll give you more information. Or just check out my articles over at StockCharts later this week. Everybody have a great day. See you next week. Happy trading.